Thank you for joining us today. We are going to be starting a new series on real estate investing. This will be the first video, and this is on the basics. So we're going to cover the basics of real estate investing in this series. And throughout this series, we'll get into more details on how to exactly identify properties, identify profit margins, and things like that. But let's start with the basics. Today, this is what we're going to cover. What is investment property? Profiting from property, financial readiness, your investment roadmap, common mistakes, and how we can help. So investment property is real estate property purchased for the purpose of earning a return on the investment. My favorite quote is begin with the end in mind. And this may seem really simple, but it is the key to long-term growth and success. Always think about the future and have your long-term goals match up with your short-term goals. Here's another great quote. In investing, what is comfortable is rarely profitable. And I have found this to be very true in my own investment. I get a little bit of anxiety and I'm a little worried every single property I buy. But I've never bought a property that didn't turn me a very large profit, and every single property I've bought was a huge success. So it's going to make you a little uncomfortable when you're making a large investment, and especially if you're a new investor and you're stepping outside of the box that you know. So it's okay to be uncomfortable. Just make sure you do your research and know you're making a good investment. Why invest in property? The main reason is the long-term benefits. The biggest benefit to owning rental property is that it's an income source. This means that it is recurring income that requires relatively little effort to maintain. It can be an attractive option for people looking to make some money on the side or even as additional financial security during retirement. Additionally, rental income is taxed differently than employment income, and long-term equity is built by renters paying your mortgage and property price appreciation. So the retirement thing is huge. I mean, property historically appreciates at 3 to 5% a year. Your cash on cash return will be very, very large, especially the longer you hold your property. So profits in property. There's a couple ways to make profits. You can make profits off of rental income. Rental income is the main source of cash flow for the business, and you want to set proper expectations through market area research. Cash flow is king. In the future resale, to me, this is where the most money is made. You want to research the property appreciation rate for the area and identify the yearly growth percent to calculate your resale goals. Most profit is made on property appreciation and equity. So years down the road, if you can calculate the percentage growth for that area, you're going to have a good idea of what you can expect to sell that property for in 3, 5, 10 years down the road. And then there's a mix of the both. When you combine the two, it makes real estate the safest and best investment that anyone can make. The pros of property investment are passive income, growth potential, stability, predictability, and increasing value. So over this last year or 3 years, you may say stability. I've got a couple questions about that. Now, although we did see rapid rise in prices, and then recently we've seen about a 10% decline in home values, overall, during that time, the stock market dropped about 30% and home prices came down about 10%. So you're not going to have the fluctuations that you would in any other equity market or investment. And that's what makes real estate still the most stable and best investment. Predictability. Homes have probably been being sold for thousands of years. We have historical data on this, and it's highly predictable that long-term appreciation rates in real estate are about 3 to 5%, depending on the market area you're in. And then increasing value over the long term, property prices have only increased. So before investing, very important part is you want to do a readiness check. And that's what I'm here for. I'm a mortgage lender at CMG Home Loans, and I can help you get financially ready. Are you ready for property investment? So getting mortgage ready is going to be to call us to set up a mortgage consultation. We're going to create a mortgage strategy that fits your investment goals. And then you want to get pre-approved for the loan you want. And you don't want to make any financial changes until you close on this investment property. Always think years ahead to make sure you're ready for the next investment. And what I mean by that is your goals are going to change each year. And if you're like me, your goals continue to increase year over year. So you want to think about 1, 2 years out. Hey, how much property do I want to buy in the next year or two? And the reason why I say this is a lot of people are self-employed and you file tax returns and you may want to do a bunch of write-offs so you owe less taxes, but you really want to think about the future and begin with the end in mind. If you're looking to acquire 1, 2, 3, 5 properties in the next couple of years, whatever your real estate investment goals are, you want to make sure that your income is lined up with your investment goals. That way you'll qualify for the loans you want to get in the future. Don't just think about the next house you want to buy. Think the next 2 or 3 houses out that you want to buy, and are you financially ready to obtain a loan and get pre-approved? So call me for a consultation. It's what I'm best at, and I'd love to help you get ready. The prerequisites for investment are make sure it's got reliable cash flow. Have an estimate of market rent versus the mortgage payment so you know your cash flow before purchasing the property. Now you don't have to cash flow on a property. I have seen strategies where it works. Even if you're negative cash flowing, the property can still work. Let's say you're negative cash flowing on a property that's $500,000. Okay, on this $500,000 property, you're negative cash flowing $200 a month. So during that year, you rent that property out, you're losing $200 a month. Okay, there's 12 months in a year. You lost $2,400 in that year. Well, let's look at how much it appreciated by. On a $500,000 house, even if we use a modest appreciation rate of 3%, that property is going to appreciate by $15,000 in that same year. So if you lost $2,400 on cash flow, but the value of your home appreciated by $15,000, you really didn't lose anything. You actually had a large net gain. So cash flow is a must if your strategy is you're using this cash to pay bills and you're using it as a reliable monthly income. Then cash flow will be a very large part of your strategy. But if you're looking further out, you're investing in property more of a retirement or a longer term investment goal, then negative cash flowing could actually still work for you with the example I just gave. And then another prerequisite, and this is my number one, is thorough research. You got to research the current market trends for your area and the historical trend of rent increases over the next 3, 5, and 10 years. Another thing I like to research is the city or town or area that it's in, are they planning to do any investments or developments in that area? I live in the Houston, Texas area. We've seen a lot of city development in an area called East Downtown. And the city was announcing these plans years in advance. So you could have bought houses there for under $200,000 just a few years ago. And now every house in that area is $400,000 and up. So with some good research, you can make a lot of money by timing the market and getting into certain areas at the right time. And then you want to have defined financial goals. Begin with the end in mind. Again, I'm going to say this a lot. Always map out your short-term cash flow goals and your long-term equity appreciation goals. Very important you have that defined. Preparing to invest. Know your financial stage. As you prepare for the financial investment, are you prepared for the financial investment necessary? Do you have the pre-approval letter in hand? Is your home loan strategy mapped out? Choose your investment strategy. Are you looking for short-term rental, long-term rental? Are you going to turn the house into a nursing home? Are you going to make it a business rental, etc.? Have your strategy planned so execution is easy? Next, you want to identify your target market. Research the ideal market for your investment strategy. Why is the area good for your strategy? Is it a good strategy over the next 3, 5, and 10 years? You want to think about these things. And then next, you want to define your property criteria. How many bedrooms, bathrooms, and square footage do you need in this house? Do you need a pool, a backyard? Does it need to be have a workstation area for business professionals or a large open kitchen for entertainment? It all depends on what your real estate goals are. Then you can define which property criteria you're going to need to make that goal a reality. Next would be setting expectations. Historical investment data. You want to research the historical trends in the area you're investing in. Find out if there is any city planning or investments that could help or hurt the value of your investment. We discussed earlier, city planning can definitely help your investment, but if they're creating some large construction, some roads, or a freeway, or something like that through your area, that could definitely affect your investment for years. And that would not be a good effect. It would hurt the value of your property. I've seen road construction cause it to where it makes it very hard to even enter a property. That wouldn't be good. So research the future plans of the city and the area as well. And then make realistic income goals. I always like to underestimate my profit margins and set aside money for repairs and maintenance of the property. There always is repairs and maintenance. And remember, repairs are tax write-off. So you'll get to write that off against the income of your business. 36.6% of all households in America are renting their homes. That is over a third of America. We have over 300 million citizens in the U.S. That means over 100 million people live in rental homes currently. 74.4% of rental properties are owned by individual investors. And why this stat is such a big one is most people think that real estate investing is dominated by large corporations or big entities, real estate investment trusts. That's just not true. Almost 75% of all rental properties are owned by individuals like you and I. So it's a great idea to buy some investment property. Here's the investment roadmap. First, you're going to start with your research and analysis. Detailed research and analysis of data is the most important step to any investment. Next, you're going to get financially prepared. Financial readiness is the key to having a strong offer and negotiation strength. When you know that you're going to be able to close on that loan, then you're going to have the confidence to walk around and go around and make your offers at the highest and best without worrying about, oh, am I going to close, or is this loan going to get approved? Make sure you're financially prepared. And the third would be property selection. The most exciting part of investing is selecting your property, but always keep profit in mind. Don't get dragged into a pretty property that you really love. It's just not going to make you any money. Always begin with the end in mind. Currently in Houston, Texas, there's 11,153 properties available for sale. Go get one. This is why now is a much better time to buy, even over the last year, 2020 and 2021. There's more property available. You can negotiate the price down or seller concessions, and overall, it's just a better market to buy in right now. Here's a couple examples: long-term rental and short-term rental. Let's look into those. Long-term rental properties are the most popular real estate investment strategy. This strategy allows the investor to have a more passive form of income with lower cash flow than short-term rentals, but the benefit is the lease agreements are generally 1 year or longer. And also, most renters stay for several years. So it creates very low vacancy, and it also makes that form of income more passive. The picture next to it is a rental property that I had for a couple of years. Actually, just sold that one. Never made the mortgage payment on that home. Cash flowed every month and made tens of thousands of dollars when I sold it in a very short period of time. So long-term rentals can be fantastic. Now, this property only cash flowed me a few $100s. So at the end of the day, I didn't make a lot of money on the cash flow of that property, but it definitely paid for the bills and any repairs that were needed and to repaint the home and redo the landscaping before I sold it. And then the short-term rental, I'm really liking this. I just got into short-term rentals. Short-term rental properties have become more common over the last decade with the growth of Airbnb. This strategy is not passive and definitely requires a little more work than long-term rentals, but the cash flow and profit margin are much higher. The downside to short-term renting is vacancy and seasonality of short-term renters. The picture next to that is a beach house that my wife and I just bought. We've got it on Airbnb. It's doing fantastic, but it does have some seasonality. During the summer, we were able to charge twice as much on a nightly rate as we can charge now. So you want to make sure you're planning for the seasonality of your investment. But what I would say on this short-term rental here, I haven't filed the taxes on it yet, so I don't know. The year's not over yet. But I'm thinking we're pulling about $8,000 to $10,000 profit on this property after paying the bills, which is absolutely incredible. So short-term rentals have a much higher cash flow amount than your long-term rentals do, but you do have problems. There's check-ins and check-outs constantly. People may ask how to work the TV, how do I work the washer and dryer? But the great thing about a short-term rental is if you are overwhelmed, there are plenty of companies that will manage your short-term rental for you for a fee. Most that I have seen take about 10 to 20% of your profit margin. And from the numbers that I'm seeing, you could still make a good profit and not manage the property. We are currently self-managing. It has not become overwhelming at all at this time. So I love both strategies. Pick which one fits your strategy better. With the short-term rental, I would say have a little bit larger nest egg just because of seasonality and vacancy rates. Common pitfalls in investing. Failing to research. Number one, research is your number one tool for success. Before I buy a property, I probably look at hundreds and I do the research. I look at the rent for the area. I compare, and we'll get into more details in later episodes on how I do this. Number two, deciding impulsively. Pretty house, looks great, you just go and buy it. Without doing the research, you could get in a lot of trouble. Never make an impulse investment. Impulse decisions are supposed to be made at the checkout line at the grocery store. If you buy a pack of bubble gum on an impulse, it's not going to hurt you. If you buy a $500,000 house on an impulse, it could cost you your business. So don't buy impulsively. Do your research. Number three, mismanaging cash flow. Save for repairs and maintenance. The cash flow is not for spending, at least for me. Some people do like to spend the cash flow. They use it as an income. I personally do not. I put it all into savings because I might need that money at a later date. Like the beach house. If my beach house gets hit by a hurricane, I'm probably going to have 6 to 9 months of vacancy while it takes the insurance companies a lot of time to repair the property. So you need to have money set aside for the what ifs in real estate. And that's why I think the best strategy is to save your cash flow for the future. Number 4, self-managing instead of hiring experts. We talked about this briefly. You want to use a management company. If you're getting overwhelmed or overstressed, use a management company. I know several good ones. If you need a contact or a referral, just give me a call or shoot me an email. I'm happy to help. Get some expert advice. Call me. Here's my phone number. There's my email address. And there's my YouTube channel. Subscribe to my YouTube channel. I'm going to consistently put out really good content that can help you be a better investor. So definitely subscribe to that YouTube channel for more information. And I put out videos daily. How we can help from planning to profit. Step 1, get your mortgage strategy and pre-approval. Step 2, identify the property you want to buy. Step 3, get estimated monthly payment info. Step 4, research estimated rent and price appreciation rate. If you can't do that on your own, I can put you in touch with realtors that can do that for you. Step 5, calculate monthly cash flow and long-term equity goal. Very important. Let's talk. How to get in touch. There's my phone number, my email address, and my website. That'll redirect to CMG Home Loans, where you can also apply for a mortgage. Thank you so much for taking your time out of your day to spend time with me here and learn a little bit about real estate investing. So we will cover future in more detail and have some more intermediate real estate investing and then advanced real estate investing topics at a later date. So please subscribe, join us again, and can't wait to see you again soon. Have a great day.